you can use self-directed plans, what types of self-directed plans are available to us out there as investors, and how you can invest those self-directed plans into real estate without dealing with toilets and tenants and ownership headache. I find that this topic is actually the one more self-directed IRA investors gravitate towards, even though we get higher attendance on the ones that we talk specifically about owning real estate in a retirement account. There's a lot of complexity to owning real estate inside or outside of a retirement plan. So I find that a lot of investors choose to do a little bit less work, sometimes sacrifice less return, putting the sweat equity on somebody else so that they can sit back and get tax-free interest payments to their retirement plan. And there's a lot of tax advantages to lending money out of a retirement plan versus lending money out of your own bank account. I run into people all the time that are already doing private lending with their own personal funds outside of an IRA. The problem with that is there's no tax benefits to doing that. You can get income by lending out your money and being a hard money lender, but there's no tax benefits. You don't get depreciation. You don't get any of those real estate tax benefits by being a lender. In a retirement plan, the game shifts a little bit because everything to a retirement plan is potentially tax free or at least tax deferred. So there's a big pendulum shift, I think, by lending out of a retirement plan versus lending personally. So I'm going to start sharing my screen here. I got one quick announcement about an event we got coming up, and just make sure you guys can see this. Let me know if you can see that, or if you guys can't see it, let me know. But let's just jump right into it, guys. So I want to make one quick announcement before we get started. If you are interested in learning more about self-directed IRA investing, but learning more specifically about alternative assets. Alternative assets are the largest growing asset class in all of retirement. It's been growing by leaps and bounds, and a lot of that has to do with the information and that we can consume on the internet. It's easier to find off-market investment opportunities, things that aren't tied to Wall Street. But those investment opportunities can range from notes, real estate, multifamily, syndications, private funds, oil and gas, mineral rights. These are all investments that we call Main Street assets because they're not publicly traded in most cases. But a lot of people are just now learning that they can put alternative assets in a retirement plan. So we do this event once a year. It's called our Alternative Asset Investor Summit. We're going to be hosting it in our backyard here in Arizona. It's going to be in Scottsdale, October 24th and 25th. If you're an avid golfer, stay for the 26th because we have a scramble that we do. It's a sponsored scramble for the event. A lot of people stick around for that. It's a whole lot of fun. And it's also a great place to build a network. If you're looking to rub elbows with investors of all categories, beginners, experienced, and advanced, this is the place to come. We don't advertise this for the 1,000-person event. Like you're going to go to some of these events, it's 1,500 people. I'll be honest, a lot of those 1,500 people might be tire kickers. They don't have a lot of money, but they're there because they got a free ticket. This isn't that type of event. I will just tell you the ticket sales on this event, 70% of the people that buy tickets to this event buy VIP tickets, right? That shows you the level of investor that comes to this event. It's usually people that have money. So if you're looking to raise more money for maybe your own deals, you want to be at that event. If you're looking for access to deals because you want to place your money with somebody, again, we don't promote the investments or the investors, but this is an educational event where you can at least meet some people and have better access to deals. So I've got a special promo code. If you guys want to buy $100, get you off a discount on GA and VIP. Tickets are going fast, but this is coming up in October. The weather should be nice. It's not 113 like it is right now, but it's going to be a great event. You get to meet the staff. I'll be there. Matt Sorensen will be there. Mark Kohler will be there. The whole gang will be there. So I'd love for you guys to get tickets. And let me know if you have any questions. Just shoot me an email. I'll have my email address here at the end. But just want to make that announcement if you guys are interested in attending. So let's jump into private lending and talk a little bit about maybe the do's and don'ts of private lending. I talk about 10 considerations to being a private lender before you lend money out of your retirement plan. I'd also do another class. We won't focus too much on it, but if you want to revert back to our YouTube page, I talk about private borrowing, which is the other side of private lending. If you're a lender or a borrower, it's good to know both sides because that's where you're going to create win-win scenarios by understanding what lenders are looking for, but also understanding what borrowers are looking for, depending on what side of the fence you're on. But we're going to stick specifically to private lending and private lenders today. Give you a little background about how I even stumbled into this industry. Real quick, out of college, I just knew I wanted to be in real estate. I didn't know what that meant. I thought you had to be a realtor to be in real estate. So I ended up going to real estate school. I had my real estate license with Keller Williams. Figured out I was more of a numbers guy, so I kind of gravitated immediately toward the mortgage industry and spent a good part of my career in the mortgage industry and loved every minute of it. Now, I owned my own rental properties. I did private lending. That was my knowledge base. And it wasn't until 2012, almost 10 years after I was in the industry, that I first heard the term self-directed IRA. At first, I didn't realize what that was. I had an IRA, I had a SEP IRA with a company, Northwestern Mutual, that was invested in a mutual fund, but I just thought that was something I just put money in and I didn't pay attention to it. In 2012, when I started learning about self-directed IRAs, first I realized, wait, I can use that money to invest in notes or real estate. I don't have to invest in this mutual fund, which I know nothing about. Somebody else is doing it for me. And that just rocked my world. I thought at that point, everybody at least needs to know that this is an option because I didn't even know this was an option. None of my friends, none of my coworkers, nobody knew this was available. At first, I thought it was illegal, but it's perfectly legal to put other types of assets in a retirement plan. The only reason most people don't is because they have an IRA or a 401k with Fidelity or Charles Schwab, and they don't let you do these types of investments because they don't make money on it. So ever since 2012, I've been educating investors of all types on what a self-directed IRA is, how they work, what are the tax benefits, and how you can invest self-directed IRAs based on a lot of the creative case studies I've done myself and through the clients that I've had over the last 12 years. But as we go through here, as a reminder, this is just for education purposes only. We're not a financial advisor. We're not telling our clients what they should or they shouldn't invest in, but we are giving the keys to the vehicle in your hand to pick your own investments. And we're going to talk a lot about that on the program today, talk about due diligence, because a self-directed IRA gives you more control. It also gives you more responsibility when it comes to picking your own investments. So just as clarity, directed IRA does not sell investments. Okay, we don't give you tax, legal, or investment advice, but we do know there's an education curve about how you use these self-directed IRAs. So we try to provide as much education as possible so that you can at least have enough information to be dangerous with. So let's just talk real briefly, and then we'll get into some do's and don'ts with lending and some actual case studies. But for the people who are new, okay, if you're interested, what is my IRA or my old 401k, my 403b, my TRS, my TSP, my Roth IRA? What am I allowed to own in those plans? If you read the tax law is very specific. Okay, they don't have a big list of investments that you're allowed to hold. They have a very short list of investments of the things you're not allowed to hold. And there's only really two investments in the tax code. The IRS doesn't want to see life insurance contracts in a retirement plan, and they don't like collectibles in a retirement plan. Collectibles are like baseball cards, antique rugs, classic cars, things that are hard to value. Outside of that, it's open game. Okay. When you want to invest in things that are outside of the traditional markets like stocks, bonds, and mutual funds, however, you have to find a company that will still be the custodian of your retirement plan, okay, and buy and hold the assets that you want to purchase, okay? And those we call alternative investments, okay? Alternative investments include anything outside of Wall Street assets and the two assets I list above. Alternative assets include things like real estate. I'm talking single family rentals, multifamily, short-term rentals, mid-term rentals, long-term rentals, land, syndications, funds. It even goes outside of real estate. You can own livestock. I had a client that owned a thoroughbred in his IRA, believe it or not. Precious metals, cryptocurrency, oil and gas and mineral rights, and promissory notes, which you can categorize as a real estate investment, but it's really a paper asset secured by real estate. And I'm going to talk about the differences between that type of paper asset and a paper asset you see with a stock. But I find that more investors gravitate toward the passive investing through promissory notes and investing in funds or syndications because it just meets their lifestyle, really. How much do you really want to work on your retirement assets? Do you want to just sit back and let somebody else do all the work and you get the income? I kind of like it because it fits my schedule, and I'll talk a little bit about that as we go along. But as a general rule of thumb, an IRA is an IRA is an IRA. 401k is a 401k is a 401k. No matter where you park it, okay, the rules are the same. It just depends on whether or not your custodian is set up to buy the assets that you want to own in an IRA. So most of our clients, truthfully, they'll have an IRA at Fidelity, for example, that'll hold their stocks and bonds and their money market accounts. And they'll also have an IRA here at Directed IRA. Okay, that could be a Roth over there, a Roth over here, a traditional there, a traditional here. But they use the IRA that they have with us to hold their alternative assets because they can't hold them at Fidelity, and you're not limited to how many IRAs you have. You're limited to how much contributions you can make to them, but you're not limited on how many IRAs you're allowed to have. So if you really want to diversify and get some of your money outside of Wall Street, you just have to find a company like Directed IRA that'll hold the alternative assets. But self-direction by them is a marketing term. It's not a type of IRA. When you look at the products we have here at Directed IRA, right, none of these say self-directed. Right. At the end of the day, we are offering traditional IRAs and Roth IRAs. We're offering SEP IRAs and solo 401ks. We're even offering non-retirement plans with our health savings accounts and educational savings accounts. I'm not going to dive too deep into these on this program, but if you go to our YouTube channel, you can find some of the other classes, the beginner classes that'll dive into these plans specifically. But self-directed is just a marketing term. We have a self-directed Roth IRA. We have a self-directed solo 401k. Self-directed just means you have to tell us what the investment's going to be, but the plan is going to be similar to the plan you have now. Okay. When you look at these plans, you want to think to yourself, okay, these are all tax exempt trusts. When you put money in as a contribution to any of these plans, okay, sometimes you get a deduction, sometimes you don't. But once you put it in the plan owns those funds. Okay, the plan is a separate entity from you. It's not your money once it's in the plan, which is a good thing because the IRS says as long as you invest within this plan is not a taxpayer. You don't pay taxes as you buy and sell investments within a traditional or Roth, a SEP, a solo, HSA, or an ESA. It's all tax deferred in most cases, meaning I'm just going to kick the can of the taxation on into the future until I decide to take a distribution, which might be 10, 20, 30, 40 years later, depending on how old you are. But there are certain plans that not only grow tax free as I buy and sell things or receive income, but when I take distributions from the plan, those distributions are tax free as well. And that's why you hear so many people talk about self directed Roth IRAs, self directed solo 401ks with Roth in it, call it self directed Roth 401k. HSAs and ESAs. These are the plans. If you can really understand how these plans work, you can get Uncle Sam off your back forever. Uncle Sam can't touch you once you reach age 59 and a half and you've had a Roth or a Roth 401k open for 5 years. Okay. All your distributions for the rest of your life are tax free and penalty free. And when you pass on those accounts as inherited accounts to your beneficiaries, they get to take tax free distributions from those plans tax free for at least another 10 years. And the reason that's important when we talk about alternative assets is alternative assets, if we play our cards right and we understand them, alternative assets can create cash flow that a stock or a mutual fund can't. Okay, real estate's an easy one to figure out, right? I own a rental property in a Roth IRA. That rental property might appreciate and get cash flow if I'm renting it out. All that income goes to my Roth completely tax free. And if I'm over 59 and a half, I can take distributions tax free as well to the day I die. But notes are the same thing. If I own promissory notes or notes payable in my Roth IRA, okay, and I'm past, let's say, 59 and a half, that's an income stream that I could live off of in retirement because my Roth IRA is receiving the interest payments on the notes it owns. And then I just take tax-free distributions from the Roth. If you have a large enough Roth IRA or Roth 401k in retirement, I always say, why would you ever do an investment in your name again as a taxpayer? Why not just invest your tax-free Roth or your tax-free solo 401k, have all of your investment income going to that plan, and then just live tax-free off the distributions? IRS can't touch you. You're off the grid. So we're going to talk a little bit about the benefits of note investing. If you want to think that that's kind of a retirement that you'd like to live, we'll talk about kind of how that works. Um, if you guys want the PowerPoint too, just shoot me an email. I'll have my email at the end. Shoot me an email, let me know because I've got some more information. I'm not going to go over this, but I took a little time to do the pros and cons of a traditional Roth, the pros and cons of a SEP or a solo, and even have some pros and cons of the HSA and Coverdell. Good information to know, but again, I'm not going to spend too much time because I want to get into the nitty gritty of note investing. But when you talk about those plans, one thing, if you want to maximize the tax benefits of all those plans, you want to use as many plans as you can establish for yourself. I'll give you an example. I have a client that recently set up 12 different plans with directed IRA. Now you're like, why would you need 12 plans? Well, he has an old traditional IRA from an old job. His wife has an old traditional IRA from an old job. They also have two Roth IRAs. That's four accounts right there. They have four kids, sorry. They have four kids, all under the age of 18. They have four Coverdell education savings accounts set up for the kids. Two of the kids are working, so they also have Roth IRAs. They also have a solo K because they're self-employed now, and they also have an HSA. All of those plans are tax-exempt trusts that they can self-direct and grow them completely tax-free. Okay. Now the traditional IRAs they're starting to convert. The point I'm trying to make here is that when you start investing in alternatives, one of the things to maximize the tax benefits on all those plans is to think about bringing all those plans together and partnering on investments, whether they partner on a rental property or ownership of a rental property, or very easy. And what I like to do, partner my accounts together on one note to a real estate investor. Now, I'll give you an example that I'll talk about a little bit later today, but I often use my Roth IRA and my self-directed health savings account as the lenders on my promissory notes loan to real estate investors. Now remember, my Roth IRA and my HSA can both be a fractionalized owner of a promissory note. It's not multiple notes. It's not multiple liens. It's two plans on one note, okay, to one investor. When that investor pays interest back to directed IRA, not me, but back to directed IRA, those interest payments are split pro rata amongst my Roth IRA and my HSA. The reason why that's different to me is because the usage of the money is different to me. My Roth IRA funds are going to be tax free once I hit 59 and a half. But what if I want to buy some new glasses? What if I want to buy some prescriptions? What if I have to get a root canal? What if I have some out of pocket medical expenses? A self directed health savings account allows me to direct my investments and take that profit out the day I make it to pay for those expenses with completely tax free dollars. If you can switch your mindset as an investor, not only can you realize you can invest in alternative assets with your retirement plans, but you can also invest in alternatives with your health savings plans and your kids' Coverdell education savings and plans, which allow you to take tax-free distributions of that profit today to pay for the expenses you're already paying for anyways. So you want to think to yourself, how many plans can I self-direct? Because I want to self-direct as many as I qualify for, because not only can you pay for retirement, but you can pay for current needs and stop paying with the money in your back pocket, HIP National, because it's off your taxable earnings. The less you have to reach in your back pocket to pay for expenses, the better off you're going to be long term because you're going to give less money to Uncle Sam if you know how to play your cards right. So let's talk about notes, and I'll take some questions here before we get into the case study. So why do so many people like investing in promissory notes? Well, if you think about it, it's real estate, okay, but it's passive. Okay. When I own a note, okay, my note is secured in most cases by the real estate that my money is used to purchase. Okay. I'm just a bank. Okay. Do banks make pretty good money? Yeah. Banks are in the business to loan, not own. A lot of people like to take that approach with their retirement plan. Okay. So as those plans become lenders, okay, you don't have to deal with toilets. You don't have to deal with tenants. You don't have to deal with all the ownership headaches that come with Real estate, okay? If you structure your deal correctly, you get what I call mailbox money. You get passive income to your plans, okay, provided you've done your due diligence and the borrower's paying. We'll talk about what happens when they don't pay. But you sit back and you just collect the interest payments based off the sweat equity of somebody else. Oftentimes, this is an easier barrier to entry to get into real estate too. If you know a good real estate investor and you're looking for, I hate it, free coaching, find a good real estate investor that you trust, that you know has a scalable business, and maybe learn a little bit about real estate by being their lender. Participate in a deal of theirs as a bank. And I'll show you how to do that safely and securely so you don't risk losing your money. Okay. Think about being a lender if you want to learn more about real estate or just want to be in real estate without dealing with toilets and tenants. Self-directed IRAs, again, and note investing allows you to diversify your investments and diversify outside of Wall Street. You could say that Wall Street and stocks and bonds are paper assets, okay, just like a note is. The difference is if I have a paper asset in Wall Street, and let's just say it's a stock with a company that I believe in, and that company goes belly up, I have no recourse. Okay, if that company goes to zero, my investment goes to zero. If I have a paper investment, which is a note, but my note is secured by real estate, okay, what's the worst that can happen if I've closed to the title company and I've done all my due diligence? Okay? The worst that can happen is my borrower stops paying my IRA. But does that mean I lose everything? No, because I am tied to the property, which is a tangible asset. So in worst case scenarios, you might end up with a house in your IRA, not zero in your IRA. So we'll talk a little bit about for the foreclosure process as well. It's important to understand that. Tax savings, we talked a little bit about that. All these plans have tax free or tax deferred growth, whereas you being a lender outside of the IRA, you get no tax benefits for doing that. And the one thing that I really like about investing in notes, particularly for myself, it's predictable. Okay. It's very hard to invest in something that's predictable, especially when you're investing in the stock market. Okay. Predictable meaning when I invest my plans, okay, as the fiduciary to my retirement plans or my HSAs, okay, I get to negotiate the terms with my borrower. Okay. I get to pick my borrower. I get to negotiate with the borrower how much my plans get as far as interest payments. Or does my plan get an equity kicker when he sells the property? Or when does the borrower have to make payments? Is it monthly? Is it quarterly? That's all spelled out in the promissory note. It's predictable. I know that if I'm requiring the borrower to make monthly payments, okay, that payment is supposed to come in on the first of the month. And if it doesn't, then I know what the next step is if I need to foreclose. I haven't had to foreclose yet, but I know what would have to happen if I did. So until that point, if the borrower that I lend to is doing what they promise, it's completely predictable because I know when payments are supposed to come in. I know how much they're for because I negotiated the terms. But at the end of the day, a self-directed IRA and the ability to invest in alternatives just gives you a chance to invest in tangible assets that you might feel safer with or you better understand. I find that people understand real estate better than they understand the stock market. And you don't have to be a real estate expert to understand what a 3 bedroom, 2 bath house is and what you need to do if you owned one as a rental. So we're going to talk a little bit about, and let me see if Marcus, are you on here yet? Let me see if you guys have any questions. I don't know. Chime in, Marcus, if you're on here. And then I'm going to see how do you handle non-performing notes when you're close to RMDs? That's a good question. So let me take some of these questions. Someone said, how do you take care of a promissory note or a non-performing note when it comes to RMDs? So RMDs is something you want to consider, especially if you've got a traditional IRA. Now, if you don't know what RMDs are, they're required minimum distributions. It really comes down to any investment, not just non-performing notes. But let's say I own a note and my borrower is not making payments to me and I have to take an RMD. So first thing is an RMD only comes with traditional IRAs once you hit age 73 now. Okay. You have to take a little bit of money out if it's a traditional IRA because, again, that's a pre-tax account. You got to pay Uncle Sam. Okay. The good thing about Roth IRAs is there's no RMDs. Traditional IRAs, there are. If I don't have any cash in the IRA to take the RMD, then I'm faced with a pretty stiff penalty. Okay. The penalties on not taking your RMD on an annual basis is 50% of the RMD amount. So the first thing I always tell people is if you've got only some of your assets here, and let's just call it a note that's not performing, but you've got some assets at Fidelity, you've got some stocks and bonds, you can actually satisfy your RMDs with us and them by just selling some stock and taking all the RMD from Fidelity. You don't have to take your RMD from each custodian. You just have to know what the total RMD is for you for the year, and you could just take it from one custodian. Now, you might run into some issues if you have no other assets anywhere else. All of your investments are into tangible investments like a note or a piece of real estate. If you don't have enough cash, you might have to pay the penalty, or you can think about doing what one of my clients did. He just converted his assets before he had to take RMDs. Now, the client who did this, I'll just tell you, he did a $2 million conversion of 12 rental properties that he owned in his traditional IRA because he didn't want to be forced by the government or by the IRS to take money out of his account. Because here was the thing, he had performing assets, rental properties that were appreciating over time, okay, and they were cash flowing. As you get older, if you keep those types of assets in a traditional IRA, your RMDs get bigger and bigger and bigger. So it becomes harder and harder to take the RMD if you have even the same amount of cash flow coming back to the account. So he said, I'm not even messing with that because these are good assets. I want all these assets to pass to my kids. So I'm going to pay the taxes now versus being forced to sell assets to take the RMDs, because that would be the other scenario, which is I could sell some assets. I could sell the note if it's non-performing and get cash. I can sell a partial. That would probably be a strategy that some note investors would do. You could sell a piece of your note if you want to take the RMD. But a lot of times, I'm just telling you, it's a lot easier to just not even deal with the RMDs. If you want to preserve wealth and preserve the cash flow, try to get those traditional IRAs converted to Roth before you have an asset that might be hitting larger and larger RMDs. So, great question. May I use a note in my IRA as collateral for a non-recourse loan to buy a note? There are certain circumstances where you can use an IRA as collateral as long as you're not using your IRA as collateral to get something personally. That would be a prohibited transaction. You can't leverage your IRA assets for like a loan that you want to get personally. But you could leverage your IRA assets for your IRA to get a loan. That's fine, but it has to stay within the IRA to do something like that. Another good question. Can you be a lender and not be an accredited investor? Yes. So this is actually a good point as well. If you're investing into certain syndications and funds, some of those syndications and funds have minimum investment requirements. Let's say it's 50,000, some are $100,000, some are even more. Now that's investing into a fund. If I'm just investing with a person, okay, let's say call it Bob, the real estate investor, I don't have to be an accredited investor for that. That's just an arrangement between me and Bob, and really my IRA and Bob, but I'm going to represent my IRA as negotiating the terms. I do not have to be an accredited investor because I'm not investing into a security. It's a note secured by property, but on the SEC level, it's not viewed as a security. Securities laws come into fact when people are raising money from multiple sources. If I'm just dealing with one borrower, it's just me as the source, even if I'm using multiple IRAs. So you're not required to be an accredited investor if you're just doing a loan to an individual or one loan to their entity per se to buy a rental property. So great questions. And let's actually talk a little bit more about some rules that you want to understand, and I'll take more questions later. There are some rules when you talk about self-directed IRA investing, okay? As we mentioned earlier, the IRS they're not picky about what your IRA invests with or what your IRA owns, but they are very, very strict about who your IRA transacts with. And you got to remember, you and your IRA are two separate people. Okay? You're a tax-paying, living, breathing person. Your IRA is a tax-exempt trust. Your relationship to your IRA is the fiduciary. As a fiduciary, your role to your IRA or your 401k or your HSA, your role is to make decisions that benefit the IRA. Your benefit comes from the distributions you take, but you can't tell your IRA to make a loan to you. Okay. That would be a violation of your fiduciary responsibility because now that loan benefits you. It doesn't necessarily benefit the IRA. And no, you can't say, well, what if I pay my interest, pay 12% interest to my IRA? The IRS does not want us self dealing with our own plans because we're the fiduciary. As a fiduciary, you can't self deal. Okay. So there's other people that are equally, and we call these disqualified persons. This is the one thing that you want to understand when it comes to self-directed IRA investing. These are the rules with the same with direct or with Fidelity. They just don't have to explain it because you're not allowed to invest in alternative assets. But when you invest in alternative assets, your plans cannot transact with these specific people. Okay. And when we talk about notes, this means my IRA cannot loan to these people. It cannot loan to myself. I can't loan it to my spouse. I can't loan it to my kids. I can't loan it to my parents. Okay. Or I can't loan it to my kids' spouses as well. So it's me, spouse, parents, grandparents, all the way up, kids and grandkids, and their spouses. You notice I left off the list family to the side. Okay. Family to the side in the IRA world consists of your siblings, brothers, sisters, aunts, uncles, cousins, nieces, nephews. Why are they not disqualified, but these people are? If you think about when you die, who you pass your assets to most likely, you pass it to the spouse, or you pass it down to the kids. That's how wealth is passed. And IRAs turn into inherited IRAs more times than not to those people. So since that's the line of inheritance, they are also prohibited from transacting with your IRA. I'll give you an example. Let's say my son is a real estate investor. Okay. If I was able to make a loan to my son as the real estate investor and then I died, okay, my son would have a beneficial IRA with a loan to himself. So the IRS just says it's black and white. We cannot allow you to self deal with those people, but you can make a loan to your brother who's a real estate investor or a sister or an aunt or an uncle. As long as it's family to the side, it's not considered disqualified. Now, I'll caution you on even investing or loaning money to family. That's another topic, but you cannot loan money to yourself, your spouse, your parents, or your kids and their spouses. Okay, those are disqualified people, and they're not allowed to transact with any of your plans. Remember, your benefit from the plan is to take the distributions from the plan. But you can't tell your IRA to make investments to you or buy your stuff or sell your notes or sell your property to your own IRA. Your IRA has to go out and do its own investments that you pick. You live tax free or tax deferred off the distributions. Okay. So let's talk about some considerations as a lender, and I'll talk a little bit about foreclosure. Now, these considerations are just things to think about. Okay. And I think these are helpful things because this is oftentimes what I think about before I do a loan with my retirement plans to a borrower. Okay. The first thing that I think about before I decide that I'm going to make a loan, I want to make sure I would be excited to own that asset if the borrower doesn't pay me. Okay. I'm pretty specific about who and what I loan on. Okay. And I'll just tell you, it's non-owner occupied property, investment property. Okay. It's single family property. That's just me. Okay. Because I want to know that if the borrower doesn't pay me, I know exactly what I'm going to do with that asset. I know what to do with a 3 bedroom, 2 bath house. Okay. I could probably do small multifamily because it's similar. I'm not going to make a loan on commercial property. Why? That's just me because wouldn't be excited to own commercial property in my IRA. I got to get a lot more people involved to run that asset than to rent out a single family 2 bedroom, 3 bedroom, 2 bath house, if you get what I mean. So make sure the asset, in the event you own it at some point in your IRA, is something you can deal with. Okay. Don't loan on something you wouldn't be excited to own. Okay. Outside of disqualified people, don't loan to anyone you would feel uncomfortable foreclosing on. Okay. I've seen this rule broken and I've seen it become real uncomfortable for certain clients. Okay. Remember, you're the fiduciary to your IRA. Okay. As a fiduciary, you have to act in the best interest of your IRA. That's really the rule, and that's the definition of being a fiduciary. The principle, the one I'm responsible for, is my retirement plan. If I make a loan to my brother, okay, who's not disqualified person, and my brother defaults on that loan. The question is, am I going to be the good fiduciary to my IRA and foreclose on my brother? Or am I going to say, well, it's my brother, what am I going to do? Well, by law, you're really supposed to represent your IRA because remember, you're the fiduciary. But because you put yourself in a position where you're uncomfortable foreclosing on your brother, now you're like, what are you going to do? And Thanksgiving's coming up. Is that going to be awkward for you sitting at the same table, knowing that you just foreclosed or you need to foreclose on your brother? So, what I always tell people is if you're going to be a lender, don't lend to people you would feel uncomfortable foreclosing on. It doesn't have to be family. It could be a girlfriend, a boyfriend, but just don't put yourself in that position where you're going to put everybody in an uncomfortable situation. There's enough deals out there that you don't have to loan to people that are you're really close with. Okay. So I'll just say that. If you're new, don't be afraid of hiring professionals to help you evaluate your deals. And even if you're experienced, I had no experienced people that help evaluate deals, and we're really talking about due diligence. Okay. Due diligence is the one thing you got to just become comfortable with, or have some people, which you can probably meet at our Alt Asset Summit to help you with this. But you want to find knowledgeable people, preferably in your state or wherever you're trying to loan, okay, that understand the investments that you're loaning on. Okay. Even to this day, okay, I've got boots on the ground where I like to lend. And before I lend my money out, I'll pick up the phone and I'll have somebody run comps for me to compare to my comps and to compare to their comps. Okay. Because I want to make sure I'm seeing everything right and the information I'm being provided from the borrower is right as well. I'm going to trust, but I'm going to verify. Okay. So a piece of the due diligence is you want to understand the asset. Okay. What are the comps in the area? Okay. How much is the property worth? What's the ARV? You want to get used to some of these terms. Okay. If you're not used to it, find somebody that can help you. And then you also want to do due diligence on the person. Okay? I got to remind people, you need to do due diligence on the person. Because if you do your investing right, you'll be secured by the property. At the end of the day, you'll get the property. But you also want to make sure that you're dealing with somebody that you can trust. It's very easy nowadays to just do a little Google search, search up their company or search up their name, and just see if you've got some negative reviews out there. People are quick to put things online nowadays, which actually makes it good for us if we're doing due diligence. You cannot count on us to do the due diligence for you. That's actually something we're not allowed to do. If you come to us and you move your money here and you have a borrower, we're not going to tell you whether that borrower is a good person or a bad person. That's up to you to decide. We're just going to tell you, here's the documents we need to make this note loan happen. And here's all the information we need for that. We're not going to give you a thumbs up or a thumbs down on the deal. That's one of the good things about self-directed IRAs, and bad things is you get to pick your own investments, but you also have to do your own due diligence. Now, the real cool things about note investing that I like is you get to structure the terms of the note, which can get really creative. And I have two investment case studies that'll kind of show you some comparison about two different ways that you can structure your notes. Now, when I'm going to make a loan to an investor using my retirement plans, I want to make sure in the terms of that note, I'm asking for payments at some point in the game. Okay. Because you can have a couple different things. You can charge interest, you can charge points, you can say how long the loan is good for, but you can also dictate when the payments are supposed to be made. I've seen this mistake happen quite often. Somebody says, well, they only need my money for 2 years. So I said it was okay for them to just pay me all my principal and interest back after 2 years. Okay. And I'm making 18%. It's going to be a phenomenal investment. Great. What happens if they disappear month one? You haven't required them to make any payments for 2 years. What are you going to be stuck with in your IRA? A note that you cannot call non-performing because they haven't missed a single payment. So, and again, you can play with this. I've done notes to real estate investors that I know were doing heavy rehabs. Now, the reason I mention that is because I know that they're really not making any money. The borrower's not making any money until they sell the property. On a heavy rehab, if I want the borrower to be successful, okay, I'm going to try to find a win-win there. Okay, but I'm not going to put myself in too much of hot water. I've done notes to real estate investors that had big rehabs where I said, I'll let you go 6 months no interest, but after that you got to pay monthly because I don't want to go too far in the future where I can't dictate whether or not that loan's performing or not. If I'm not collecting monthly interest, it's really hard to call that a performing or a non-performing note. So just something to think about as you negotiate terms and you put those terms in the note. Also, when it comes to large rehabs, be careful how much money you tell your IRA custodian to front for the rehab costs. Now, again, there's different ways you can do this. You can ask, I know a lot of lenders that prefer their borrowers to pay for the rehab costs and they just front the money to purchase the property. But I know some want to be a little bit more flexible and they say, I'll lend you the money to buy it and I'll lend you the money to rehab it, especially if there's a large ARV or the investor found it at a steep, steep discount. Okay. I've done one where the rehab was more than the purchase, was more than the acquisition cost of the property. Now, in that case, be careful fronting all of the money for the rehab up front. Because here's an example. Let's say the property, the borrower needs $70,000 to buy it, $30,000 to rehab it. And let's just say the ARV is 125, just making up a number. Well, if I loan money, okay, out of my IRA and I give them the 70 to buy it and the 30 to rehab it up front, and then borrower Bob disappears, okay, I take the property back in foreclosure. What hasn't been done yet? The rehab. How much did I lend Bob? 100 grand. What do I still need to pay to get that property sold now that's owned my IRA? I got to throw another 30 grand in to do the rehab. So now I'm in it for 130 instead of 100, and I sell it at a loss. So just be careful on fronting too much of the money up front. Now, here's kind of some things you can do to avoid that. Ask them to submit invoices to you, okay, and show you the repairs that have been done before you send them money and maybe reimburse them. Maybe say, you pay for the expenses and I'll reimburse you once you hit $10,000. Okay, show me the invoices and I'll tell my IRA custodian to send you $10,000. But send them increments and not the whole chunk before you've actually even verified that they've started or done any rehab, especially on larger rehabs. Okay, there's stuff to think about. Now, this comes back to the banking world. Again, if you're going to use your IRA like a bank, think like a bank. A couple things you want to make sure of. Okay, if you're going to be a lender, make sure you close at a title company. No Starbucks closings. Okay, I've seen a lot of people lose their money because they thought they were secured by the property, but they didn't close at a title company. Okay, close with a title company, get clear title, make sure there's no hidden liens on there, make sure your money is tied to the property or secured to the property with a deed of trust or a mortgage, or close with an attorney's office so you make sure that is a ultimate rule I will never break. Also, make sure that your IRA is listed on the insurance policies. You want to make sure if the house your money is secured by burns down, that you're going to get a check reimbursing you because they use your money to buy the property. Now, some insurance companies will give you a little pushback on this. Okay, they'll say, "Well, we can't put what's an IRA. We look for people." You can always, at least most insurance companies will put maybe the owner as the insured, and then you can have an additional insured as the IRA. But make sure you deal with a insurance company that's going to put you on there as either the mortgagee, the insured, or the additional insured on any insurance policy, whether that's homeowner insurance or flood insurance. So you make sure your IRA is made whole if something happens to the property. Also, another big one, make sure property taxes are paid and current. This is very easy for lenders to do. Either have your borrower show you evidence that the property taxes are paid, or just go online and look at the county assessor's page and make sure that the property taxes are current. The one thing that can sneak up on you if your borrower is making payments on time, you might think the investment's going well. But what if somebody is forgetting to pay the property taxes? Well, the county assessor could take the property away from both of you. Just make sure property taxes are paid. It's easy to look up the property online, go to the county assessor's page, make sure property taxes are paid and current. Okay? If you're loaning to an entity, ask for a personal guarantee because entities, there's a little less a guarantee. There's no real recourse to it, to an entity if there's no assets in it. So if you're loaning to an entity or a company, make sure you can ask for a personal guarantee. Sometimes you'll get it, sometimes you won't. And if a loan goes into default, if your borrower misses a payment, take action immediately. And that leads us to foreclosure because taking action does not mean foreclosing on a property. Taking action just means sending a notice of default in most states. Okay. So most of the clients say, well, what about foreclosure, Nate? What happens if somebody doesn't pay me? Well, the cool thing about foreclosure is, what about it? Okay. It's important to understand what it is, but it's just a legal process for you to get the property back if your borrower doesn't make a payment. In some cases, some states make it very easy to take your property back. That's why I like loaning in Texas. Okay. That's why I'll never loan excuse me if anyone lives there, but I'll never loan in California and I'll never loan in New York, just because I know the laws protect the homeowner over the lender. I just don't want to be in a position where I can't get my money back. So I stick to business friendly states that I know if my borrower defaults, I can take the property back. Okay. And normally you're going to find easier processes through states that use a deed of trust. Okay. That's what, so you want to know where the property is that you want to lend. Okay. Is it a judicial foreclosure state or is it a non-judicial? The terms just like it is. Judicial, you got to go through the courts. Non-judicial, you don't. Okay. As soon as you got to go through the courts, things might take a little bit longer. It's okay to loan money outside of the state that you live in. That's why I see a lot of clients, they might live in New York, but they lend in Texas, okay? Because they just want they want less headaches. They want to make sure that it's in a non-judicial state with a deed of trust. The deed of trust is the document that allows you to circumvent the court systems. I mean, it's just a much easier process. And I'll just give you an example. If I had to foreclose on one of my properties that I'm secured by in Texas, they're all non-owner occ, they're all investment property. I can get that property in 90 days. That's extremely fast when it comes to taking over property. In some other states, it could take 2 years. I'm not locking my money up for 2 years if the borrower doesn't pay me. I'm just not doing it. So understand whether or not you're dealing with a judicial foreclosure state or a non-judicial state. What documents secure your lien? Again, once you learn this, it's like riding a bike, but understand if it's a mortgage state or a deed of trust state. How long does the foreclosure process take? Very important. Foreclosure process could be different based on if is the property an owner occupied property or is it a non-owner occupied property. Now for me, again, just a tip, I do not loan people money on the house they're going to live in. That's not why they should be coming to me. Okay. If you want a mortgage for a house you live in, go to Bank of America, go to Wells Fargo. They're going to have much better rates than my rate, and that's who you want to go to for that property. But if you're buying a flip, if you're buying a property that's been vacant for 2 years, you want to rehab it, flip it as a real estate investor. That's an investment property. Okay. I loan on those all day because they're not going to be able to go to Bank of America or Wells Fargo and get very good terms on that. They're going to ask for a lot of money up front. They might not even do it based on the condition of the property. But at the end of the day, for me, it's an investment property. I'm okay foreclosing on investment property because I know, hey, I'm not kicking people out of the house. I can just take that property, and if there's renters in there, I'll just continue to rent to them. And I don't have to fall under any Dodd-Frank laws, okay, which protect owner-occupied properties, but do not apply to non-owner occupied properties. So I'm going to have a lot easier time dealing with an investment property that I'm secured by versus a owner-occupied property, which I will not even touch. Okay. No, some people will, but again, it's just not what I want to do. So also understand if the borrower has redemption rights. Certain states have redemption rights, meaning once you foreclose, there's a certain amount of time where the borrower can come back and pay and get the loan current again, which is a good thing, but it does keep you holding the property a little bit longer without being able to do anything with it because you got to wait for those redemption rights to expire. So just understand foreclosure, and I'll just tell you this: foreclosure is not the worst case scenario. Okay. Worst case scenario is that you're not secured by the property and you don't understand the foreclosure process. But I've actually seen investors actually have to foreclose on property and make more money in foreclosure than they would if the borrower made payments because maybe there was a lot of equity in the property. And truthfully, most of the loans that I've seen go into default, most of the loans that I've seen borrowers not pay, it's not because the borrower was a bad person. It's not because the borrower was trying to be shisty and just not pay. It's because the borrower died or the borrower got sick, or the borrower just might have overextended themselves and they need to sell off some assets or get rid of some assets. I've even seen borrowers give back assets to lenders through like a deed in lieu or something like that. But you just want to make sure that your plans are protected and you close at a title company. You at least have that option because again, you might wind up with a property and that property might give you better cash flow than maybe even the interest payment. So it's not the end of the world, but you do want to understand foreclosure. I'll say this as well. One thing on foreclosure, borrowers, make sure you hit that topic head on. Okay. Don't shy away from telling your lenders how to foreclose on you. That's being transparent with your lenders. But also at the end of the day, you don't know what's going to happen after you guys close on this deal and you walk out to your car. Again, life happens to people at the oddest moments. you got to make sure that you had the conversation with your lenders about here's how to foreclose on me. Here's what happens in the event I can't pay you or something happens to me. You'll find that more people are willing to lend you money if you've educated them on what happens when you cannot pay. Because again, you're not saying you're a bad person, but you're saying that, hey, life might happen, and here's what you want to do on that. Marcus, are you on? Let's see if Marcus is on
I
yet.
am. I am for a few more minutes. Yep.
Awesome. Do you have any questions that you want me to answer? Are you good on questions?
Let's see. One popped up here. Can I use my IRA to lend in second position, or does it have to
Yes.
be first, which can be
Very
either?
good question. You can lend in second position, third position. I've even seen fourth position. There's some goods and bads to that, obviously. It sounds just like it sounds. Obviously, most investors want to be in first position. Okay. First position just means in the event of default, you're the first lien that gets paid. Okay. You're the first debtor that gets paid. If you're in second position, well, you're the second position. So as long as there's enough equity in the property that you're not worried about being covered on your position, then it's fine. Once you start getting in third and fourth, then it's really a question of how much equity is really in the property. Because if you don't have enough equity to pay, the people in the later positions are usually the ones that could get screwed. But here's the positive side to that. When you're in a second or third lien position, the higher you go, the more interest that you can typically charge. Okay. So if I ever did, a second lien position, I'm not charging 7% for a second lien position. That's just me. I'm charging 12, 13, 14%. I've even seen some second lien positions as 18%. Some borrowers need that though, because they just need that extra cash. It might be 10 or 20 grand to just finish the rehab. Okay. So again, there's some goods and bads to it, but I know a lot of people make it a business out of just doing secondly mortgages because it's a way you got to weigh out your risk. It's a little bit riskier, but you could charge more to offset that risk. Okay, so let's look at some actual real deals. Okay, and to realize when you are a lender, okay, and a borrower, one of the things that's beautiful, again, this is a negotiation between two parties. Okay, you can structure win-win scenarios and every deal doesn't have to be the same on every single property. That's one of the beautiful parts about it. Borrowers understand you have tools in your tool belt. You don't have to just offer the same thing to every investor on every investment you find because every investment is going to have a different story to it. I've seen great investments that are just real simple. Simple interest loans are the most common ones we'll talk about here in a second. I've also got an example of a shared equity loan. Okay, why the heck would a borrower want to share equity with their lender? There are reasons, trust me, but it's a tool in your tool belt to give to your potential lenders. I've seen convertible notes. Convertible notes are typically notes on to businesses. You can loan to businesses and you can loan to people buying real estate. You can even secure your loans on businesses. I saw a loan that actually turned out really well. Had a client that had a financial friend, not a disqualified person. They were starting a medical device company. They had already worked at a Fortune 500 company. They started their own company. The client wanted to use his IRA to be an investor on this company. It was a medical device company and they had a note which was a convertible note. Convertible means it starts out as a note where the borrower pays interest, but at a certain point, if the property, if the sorry, not the property, if the business becomes successful, they can convert their note into shares of the company. Okay, that's a very good investment if the company is going to go public or you believe in it. But you can also have a security instrument that says, in the event of default, my IRA gets all the medical equipment. Well, you can sell off the medical equipment and get your cash back. It doesn't always have to be real estate, but you do need to have some sort of security agreement if you want to do something like that. We're going to talk about that today, but just giving you some things to think about. Real estate options and joint ventures are other ways. That's not really borrower and lender positions, but they're just creative ways that you can structure a win-win scenario. We're going to talk specifically a simple interest and shared equity just to give you some examples. So this is a deal that I did where pretty basic deal. Okay. I've got about two or three people in Texas, Houston specifically, that have pretty good track records on the investments that they do. They've been in the business for decades. For me, that's part of my due diligence. Part of my due diligence. How long have you been in the industry? How many properties have you bought? I'm a little hesitant to lend money to somebody who hasn't done a real estate deal yet. I'm more apt to loan to somebody that has some scalability and that's done a lot of deals. Even if they've lost money on deals, they've got a little bit more experience and potentially they might have more skin in the game. So Where do you meet these people? I always hear this. Well, one of the places that I've met a lot of people is just at local RIAs. Okay. Every city, every state has a local real estate investor association. That's oftentimes where you can go and attend, you can learn, you can meet people that are buying off market deals. Start with some of your groups. There's also groups online. Be careful with dealing with people online that you trust, but there are some decent groups on Facebook that have real estate investors constantly promoting their deals. Okay. Elite Deal Makers is a good one. Again, not promoting. I'm just saying you want to participate in some of these groups, kind of see what's out there. Or you loan to anybody, make sure you get to know them, make sure you do due diligence. Just kind of giving you some places to look for potential access to deals and attend the events that we put on. I kind of mentioned that at the beginning. We've got an event. There's going to be 300-400 people at that event. A lot of them are real estate investors. You want to find access to deals. You got to get out there and do a little bit of networking. So I've networked enough where I know some investors, and if they need quick money, they come to me. Okay. Now, here's the difference between private money, which is my money, hard money, which is a hard money lender, and conventional money. Okay. Conventional money first, that you're going to get better interest rates if you're borrowing money from a bank. Everybody knows that. But when it comes to investment property, what's the bank also going to want? They're going to want 30% down in some cases. They're going to want your social security. They're going to want your tax returns. Make sure you got 2 year history. They're going to want your firstborn. They're going to want all sorts of things before they even tell you you can buy this property. In the real estate world, if you're trying to rock and roll and move and shake, oftentimes that process is not going to help you buy more property. Now, that's why a lot of people go to hard money lenders. Hard money lenders are faster. They might require less of you to qualify for the loan. They might even do it as an asset based loan. You might not even need good credit to deal with them, but they're gonna hit you with the interest rate again, cost of doing business. You're gonna pay top dollar for borrowing that money, and they're gonna be a little bit faster, but usually it's still gonna take about 2 weeks to borrow money from a hard money lender. Private lending, it's a negotiation. It's a relationship between me and the borrower. Okay. We negotiate the terms. Okay. It's not just a bread and butter boilerplate. Here's your interest rate. It's what interest rate would make this loan work? And does it need to be simple interest or can we share some equity on this deal? And if we've got all our ducks in a row, my self-directed IRA company just needs me to fill out a form and provide them a promissory note. And as fast as we can do that, that money can be out to the borrower in 2 days. As a borrower, that's important because you think about that. You can buy more property if you can go into negotiations with cash offers and say, I can close in 2 days, provided you've got some self-directed IRA lenders lined up and ready to go. So here's a deal that I did with my self-directed Roth IRA and my self-directed HSA. Okay. Rounded these numbers, but the borrower needed $100,000, $75,000 to buy it, $25,000 to rehab it. Now, how we did this as far as the rehab, I had the money set up in an escrow account that I just told the escrow company to give them a certain amount of funds as the rehab took place. That's another way you can do it, is just have a third party hold it in escrow and you tell them when to send money to borrower. Okay. Now we structured the terms. This is often my common terms with a borrower. Okay. It was a simple interest note, which means they just have to pay interest payments starting month one. Okay. And they have to pay in the first of the month. And how long do they have to pay? We usually have the loan amortized over 30, which just means the payments are spread out as if they were making payments in 30 years. But because it's an investment property, there's a balloon which says you got to pay my plans back within 18 months. Okay. Now, the reason I do 18 months is because, again, my money is meant for short term. Okay. On this particular deal, this was a deal that the borrower found that was vacant for 2 years. Okay. The grass was taller than the house. Okay. It was in a rough area of town, no HOA. So nobody was really doing anything with this property. It just looked nasty. The concrete was all overgrown. I remember the walkway up to the house had a big crack in it, and you could just see it like bowing because there was like something growing underneath it. So, but he found the owner of the property who was living in another state, who inherited the property, who didn't even know that it was really meant for him. He didn't know what to do with it. And this person actually needed money at that time. So the borrower who found this vacant property owner, he got a real good deal on this. He said, well, what if I give you 75 grand in a few days? Said, I'll take it. Okay. Borrower didn't even really know what the property was worth. He just needed the money. And the ARV on this property was 215. Okay. That's what the borrower actually told me. When I comped it out with a friend of mine, he told me 237. So for me as a lender, I'm like, okay, worst case scenario, I get a property that's 237. Let's strike up this deal. So as part of the deal, negotiated 2 points up front, which is just upfront interest. So over the course of 12 months, my IRAs look to get 14% return, double-digit returns backed by real estate. When we draft the promissory note reads as follows. Okay. It has two lenders on the note, directed trust company for the benefit of Nate Hare's Roth IRA. And there's an undivided interest of 75%, meaning my IRA my Roth put up 75% of the total capital. My HSA put in 25% of the capital. I've seen notes. I participated in a note. We had 8 IRAs on one note. It's not multiple notes. It's not multiple liens. It's just called a fractionalized note. Okay, you can have as many parties as you want on one promissory note, and the borrower doesn't have to make multiple payments. They pay one payment as long as it's all with one company, and they split the interest payments direct based on the ownership percentages. We closed at a title company. Okay, my directed IRA cut the check within 2 days. My notes secured by the property with a deed of trust in the event of default. And here's the other thing that I always negotiate that I forgot to put in here. My borrowers, and this is something you should think about borrowers too, is I always have my borrowers pay my directed IRA fees. Okay. My administration fees. Because if those of you who have accounts, you've got a 395 asset fee, or sorry, 395 account fee, times that by 2. Okay, because I got 2 plans. I've got fees on my asset or fees on my accounts. I've got a small transaction fee of $50. I have my borrower pay my IRA through escrow to cover my fees because I know and they know that if they go to a bank, they're paying much more than a couple $100 to borrow money from Bank of America. They're going to pay 3% in most cases on just in fees at a typical bank. They're only paying a couple $100 to reimburse my IRA for the fees that I pay. The other thing that allows me to do is I know I'm making a flat, even 14% annually. It's not 14% minus my fees. Okay. So think about that, guys. That's a good way to keep more money in the account. And borrowers, you should be offering this because this makes everything easier for your lenders. And it's a cost of doing business for you. You can write it off as fees that you pay as a real estate investor. But think about that because I have that in every single one of my deals. My borrower pays my directed IRA fees. Okay? Now, from that point on, all the interest payments are coming back to directed IRA. They split it pro rata. So I can use money out of my HSA if I want to pay for health expenses today. I've got money in my Roth IRA that's growing completely tax free. Now, usually on most of these deals, because I have it as an 18-month term, okay, the borrower usually holds the property for a year and a day. Why do they hold it a year and a day? So if they want to sell it, they don't have to pay short-term capital gain. So I want to give them that flexibility. There's an optional extension in the note too. So if the borrower is making payments on time, and I've actually had to do this because interest rates are a little bit higher, a lot of the borrowers can't refinance to much better interest rates. It's not like going from 12 to 2 or 3, like it was in the past. 12 to 7, a little bit more of a decision maker. So I've actually extended some of the notes just to keep the notes active and allow them to pay. But in most cases, when interest rates are reasonable at a conventional bank, they usually just refinance my loan. I get paid off from the bank, and then we do the investment again. The reason I like to get paid back sooner is because I get to compound my interest. Okay. If you look at this chart, if I'm loaning $100,000 out and I'm making double-digit returns, if I can get my money back within a year and then redeploy it, I'm now not just making double-digit returns, I'm compounding my returns. And compounding my returns, if I just do this for 20 years, that $100,000 with no additional contributions will be $1.4 million off the sweat equity of somebody else. Okay. The hard thing about that is you got to find access to deals. Okay. But compounding interest in a tax-free account is what Einstein, I think, was thinking of when he said the eighth wonder of the world is compounding interest. Those that don't understand it, pay it. Those that understand it, earn it. And this is a way that you can earn compounding interest tax-free is by using your self-directed plans. Now, here's a shared equity deal. I want to show you a different side of things when a deal doesn't quite work as a simple interest deal. Now, this was a mobile home outside of Fort Worth, okay, that we participated in as a bigger group. Okay? Here's the deal with this property. It was outside of Fort Worth many years ago. The value on this property was really the land. It wasn't the mobile home, the double wide mobile home that sat on top. It wasn't that the investor was trying to buy. They just wanted to own this land because it was a mobile home tied to the land because they figured in 5 years population was going to grow and hit this area and this land was going to be very valuable. So it was a buy and hold. The problem with where it sat, it wasn't something that can be rented to a long-term rental. It was more of a short-term rental, a vacation rental. People went there in the spring and the summer to do some fishing. Okay, but it wasn't something that you rent, to a renter that's just going to live out there for 12 months. So with a deal that they would have to pay 12% interest, even though they can get the money fast, they would have been in the red because they can't rent the property out for enough to cover the mortgage payments. And as a buy and hold, that payment now becomes onerous. Well, as lenders and borrowers, you want to try to see if there's a win-win scenario. Now, the lenders in this case, they liked the property too. So what they decided to do, okay, is back the transaction up and say, hey, look, borrower, what do you think you can get in income from the rents? Let's use that number, and based on what you want to borrow, what would be the interest we could charge that'll allow you to break even? Okay. And we came up with 6%. 6% was the interest rate that would allow the borrower to make payments, okay, and have the rents cover all those payments so they wouldn't be in the red. Now it's not an onerous loan for them. They could just hold the property. But in return, okay, what we asked for is 50% of the equity when they sold. Okay, we're going to drop our interest rate by 12%, by 6%. Okay, we're going to cut it in half. We're not going to charge any points up front because now it's a different deal. It's not short term, it's long term. And this is just called a shared appreciation mortgage. We have a clause in the note that says when the borrower sells the property, the lender gets 50% of the note. Now you're part of the risk, though. It can go one way or it can go another. In this case, it worked out very well. The borrower held the property for 7 years. Okay. When the IRAs all got paid back, we got 6% over the 7 years. Okay. It's better than poking your eye with a stick. Okay. 6% is great in most cases, but we also got 50% of the equity when they sold. So if you think about this, the borrower put no money into the deal, okay? Had no onerous payment. The rents in the area covered the mortgage. So over 7 years, the borrower literally came out of pocket with nothing. Okay. And when he sold the property, he walked with half of the equity, which was 80 grand total. So he got 40 grand. The IRAs got their 6% and an extra 40 grand at the end of the day. How'd the IRAs do? IRAs did pretty good in that investment. How'd the investor do? Okay. Some people say, well, he gave up all his equity, but he didn't have a deal to begin with. He was almost walking from this deal because he couldn't afford the payments. And this was a mobile home. Not many options on mobile homes if you ever go to a bank and try to get a loan from them. But if you think about it and back it up, he put no money into the deal. He put no money to hold it for 7 years, and he walked from the title company when he sold it for 40 grand. If that was the situation on every single deal, how many deals would you do like that? You do every single one. No money in, $40,000 out. It's like a tax-free ATM you could just keep drawing from. But that's the way that you can think outside the box when it comes to private money because you can negotiate things like this. You can negotiate winning terms. And as a borrower or a lender, just understand that you have more options and you can get creative and create win-win scenarios. So I hope you guys learned something today. Marcus, if you've got questions, I'm down to take questions now, and I'll just leave this up for a little bit for you guys. If you guys want to email me, if you want a copy of the presentation or recording, if you want to book a call with us, here's all the information there. Marcus, fire away questions if you got them. Oh, maybe he had to jump off. So let me just look at questions. All right. So is the payments being made from the borrower in a bank? Oh, wait. Is the payments being paid from borrower in a bank owned by directed IRA? So we don't own our own bank. We are a custodian, though. So what we have is we have 9 different banks that we use to hold deposits for our clients. Now, you might think, why the heck do you have 9 different banks? Because we need to make sure as a custodian, okay, that every dollar we hold is FDIC insured. And we have to make sure it's FDIC insured by making sure an individual client at any point doesn't have more than $250,000 of cash at any one time at any one bank. So we'll make sure on clients that have a lot of cash that we make sure we separate that money out so everything is FDIC insured. So we have different banks that we utilize for that. Okay. But that's a good question. So as you pay, obviously the payments come into us, but then we're going to deposit that into a non-interest bearing account that's going to sit at a bank. It's FDIC insured, so your cash is protected, and it's basically available for you when you want to redeploy that money into another investment. Or if you don't want the money just sitting here, not making anything, and you don't have another investment, just transfer that money back out to Fidelity or Charles Schwab. That's why it's good to have multiple IRAs so you move money back and forth depending on when you need it. Okay? When doing private lending from self-directed IRA, should you have an IRA LLC? I love this question. IRA LLCs are an optional structure, okay, for you. In this case, I would say for a little bit more ease of use, or if you're using multiple accounts. Now, for me, I don't use an IRA owned LLC because I don't really need one. Okay. All I'm doing is right now, I'm just loaning two plans out, right? Two plans is very easy. I got to fill out two direction investment forms. Okay. I got to put two notes on the note, or sorry, two plans on the note, but money's going out once. And then all I got to do is have deposits made by the borrower. Okay. I don't need an LLC to do all that. An LLC for me is actually just a wasted expense. And I'm not looking for added asset protection because I don't own the property. I just have the IRAs that are the lender secured by the property. So I have enough protection there that I don't need the LLC. Now, if I'm going to do a lot of notes, okay, let's say I'm going to do 2 or 3 notes a year. And let's say that I've got 6 or 7 accounts, not just two. Well, I got to remember that if I'm doing all that without an LLC, I'm going to have to submit 6 direction investment forms to the custodian. I'm going to have to do 6 different things every time I want to deploy money. So I might want it for the ease of use. There's obviously got to weigh the cost in setting up the LLC. Our KKOS lawyer team is very good at setting up IRA owned LLCs. You can have your IRAs or plans be the owners of an LLC. You manage the LLC, you've got access to the checkbook, and you can just make loans where the lender is just that LLC. It makes it really easy because you have the ability to put all the money into one location. You do have to be responsible with that because there's no line of sight from us because we don't know what you're doing with that LLC. So you got to make sure you understand prohibited transaction rules. So I would say with real estate, it's a little different because a lot of times owning real estate, there's a lot of moving parts. You got to pay contractors and things like that. Once you get into the more passive, it becomes less of an issue to have that control. But I would say the more accounts you use and the more active, you might want to look at an IRA owned LLC, but it's not a requirement. Let's see. Any suggestions, recommendations? Real estate company who is looking for loan to accept IRA as loan. Any suggestion, recommendation? Real estate company who is looking for. Okay, so I think you're just asking for access to deals. So we can't recommend certain investment providers. What I would say is, I said it early in the program, do a little networking, join some groups on Facebook. I'm part of some really good groups that there's some people there. I'm not saying that should be your end all be all, but get familiar with some of the people that are active in real estate. Attend your local RIAs if you want. Try to meet some real estate investors that you know and trust, preferably in a state that you want to loan in. If that's your state, fine. Some people like to loan in the states that they're in, even if the foreclosure laws aren't as advantageous. They just like the ability to be able to drive by the property, inspect it if they need to, if their money's tied to it. But that's one thing we can't do. We can't give you guys people to invest with, but these programs are hopefully helping you guys connect with each other through the chat. So also, it's good to meet people and shake them and look them in the eye face to face. I always encourage people, come to one of our events, come to the Alt Asset Summit. It's one of the greatest places you can come to learn more, and you meet some phenomenal investors. It's well worth a couple $100 to get a ticket and hang out with us in October. So make sure you guys get tickets to that. Can I lend to family members or brother or sister? We talked about that. There's certain family members you can't loan to. You can't loan to yourself, your spouse, parents, grandparents, kids, or grandkids, or any entities they own or control. Family to the side are okay, but be careful, right? That's brothers and sisters, aunts, uncles, cousins, nieces, and nephews. So that we talked about that as the disqualified persons. If you missed it, just ask me for a copy of the recording and I'll send you the recording this week. What happens if you are in second line with real estate with the bank and the borrower defaults on your loan, but you are not the main loan, so your recourse is stuck? So I think you're just asking about if you're second lien position. We talked a little bit about that. Second lien position, third lien position, fourth lien position. As you get deeper into those positions, your main concern is there enough equity that if this property gets sold at auction or we got to take it back and sell it, obviously you get paid in that order. The further you are down the trough, okay, the more risky it is for you. So if you want to be in that later position, make sure that you're charging enough to alleviate that risk, but then also really just make sure there's enough equity in the property that you're not worried about getting paid. Because the first lien holder, they're going to be made whole before anybody else is made whole. So it's okay being in second lien position. You can actually, I know investors that specifically loan in second lien position because they know they can loan at 14, 16, 17, 18%. But they make sure that the properties have enough equity to make them feel comfortable in that position. So, how much do legal costs on the foreclosure typically cost? That can really vary. That can depend. Typically, not that much, to be honest, especially in Texas. But you want to just check that out with your state. I can't really speak on that, but normally it's not a whole lot of money. The bigger cost, I think, is if you can't foreclose, holding costs that you might have with a property that you cannot take back in foreclosure. That's something you want to definitely weigh out. Can partners in a joint venture loan to each other from their self-directed IRAs? Ooh, that's a good one. That's a gray area. There's certain people in your life, if you're doing business with them, they can be a disqualified person without being related to you. I'll even give you another example. I have my brother is actually the beneficiary on my IRAs. Why? Because I'm not married and I don't have kids. So I need to leave it to somebody. So by default, by putting my brother on as the beneficiary of my IRAs, he now becomes a disqualified person because he's in line to inherit it. Okay. That's not your question. I understand that. But in the eyes of the IRS, anybody who's a fiduciary to your plans is disqualified. Now, one of the fiduciaries is us. We're a fiduciary to your plan. So you can't lend money to us. Not that you would, but we're a fiduciary. Sometimes your attorneys could be fiduciaries. If you've got trusted advisors or a trustee, they can be a fiduciary. So you can't loan money on your IRA to a trustee of a trust or something like that. But when you put business partners together, it really depends on how tightly wound you are together, whether or not your partner on a joint venture is also considered a disqualified person. And I definitely wouldn't want to tell you that you can loan money as like a trade. I've seen some clients try to do this. You can't say, let's say me and Bob over here are business partners and we're not related. I can't just loan money to Bob and have him loan money back out of his IRA back to me. Because really what we're doing, if we're not really investing that money, all we're doing is we're doing a prohibited transaction. We're loaning money to ourselves, but we're using each other's IRAs to do it, is really what we're doing. I actually had two clients submit two promissory notes one time for the exact same amounts at the exact same interest rates, and they were both unsecured notes. That's prohibited. You can't do that. You can't just do a prohibited transaction and use a ghost borrower to get money out of your IRA and get money in your pocket. So as long as it's a separate investment, as long as even if it's a business partner, as long as it's, let's say, your business partner, your joint venture on a deal, but you guys are doing your own different investments, and the loan on that is secured by this investment, and they're at different times, then that seems to be okay. But just be careful, tread carefully with that, especially if you have some prior dealings with that person. Looks like a lot of these questions are repeats. I would probably just say if you guys have additional questions that I haven't hit, because we're running a little short on time, shoot me an email, just copy and paste. Here, my email's right here, nate.hare@directedira.com. If you want to schedule a call with me too, you can scan that QR code or just go to our website, directedira.com. I also have a special discount if you guys want to establish plans. If you're new to the game, but you've got some money at Fidelity that you're not happy with the returns, you want to start investing in something more in your wheelhouse. Make sure you use that discount code RYR100 when you open an account. I hope this was helpful to you guys. I'm going to stop share here, but if this was helpful to you guys, just let me know in the chat. Let me know if you guys want to learn a little bit more about other things. Our next program, we're going to talk specifically about syndications and funds. So another different way to invest passively with your retirement plan. It's different than a note, but it is a more popular investment than just owning real estate, doing a little bit more passive. But if you've got questions I didn't hit, email them to me. Email me if you want a copy of the presentation or a copy of the recording. We'll send that out. And I appreciate you guys attending. I hope I see you guys on the next one. And I really hope I see you guys at the Alternative Asset Investor Summit. It's going to be a great time. And I will tell you from experience, sometimes those events introduces you to the person that lets you scale up your business or take your alternative investing to the next level. You just don't know, but you got to put yourself in the room of people that might be able to make it happen for you. So thanks, guys. This is Nate here with Directed IRA signing off. Hope to see you guys soon. And again, email me if you guys want the recording. Have a great rest of your week.